Okay, good morning, everyone, and welcome to this morning's Coffee Microcaps Morning Meeting. My name is Mark Tobin. For anybody who hasn't joined one of our presentations before, and for all our regular attendees, you're very welcome back to this morning's session. I've got a couple of intro slides I'm going to run through here, and then we're going to get straight into it with our first presenters. I would first like to mention RAS Research as a Service. If you are looking for some institutional grade research on some small and microcap names listed on the ASX, please do check out their research coverage on the RAS Group website. Quick compliance and disclaimer slide, and welcome to any of our friends from ASIC who are joining us this morning. You're very welcome. For anybody who is joining us for the first time, the companies we generally have presenting on here, we usually run these kind of every 2 weeks or so. Capped under 300 million, that's our definition of a microcap, I should say. Generally, companies who are in revenue and cash are heading towards cash flow break even, or indeed are already profitable, as are some of our presenters here this morning. We tend to not have companies from the resources and biotech sectors. So kind of everything else outside of that, which we define as kind of industrial microcaps. Structured this morning's webinar, we've got 4 companies presenting with us this morning, so a full house. Each company is going to get 30 minutes, which we'll break down into a 20-minute presentation and 10 minutes of Q&A. If you do have any questions for any of our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier to moderate the questions. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Monday. Follow us, you can pretty much get us on all of the socials. Twitter is probably our main one. As I said, YouTube for the recording of this webinar, and indeed all our previous ones. We've got well over 100 webinars done now at this stage, so plenty of content on the YouTube channel. You can get us on LinkedIn, and I also write a free monthly newsletter that you can get on the Substack platform. Our first presenters, I'm delighted to say we're welcoming for the first time here on Coffee Microcaps. We'll have Change Financial. We'll be joined by Tom Russell and Tony Sheehan just momentarily. After that, we'll be welcoming back Tony Abrahams from AI Media. Again, after that, another returning presenter, we'll have BNK Banking Corporation. Allan, Savins CEO, will be joining us once again. And then we've got another new presenter joining us as our final presenter of the morning. We'll be welcoming Mark Benson from Saunders. So without further ado, I'm going to stop sharing my screen and hand you over to the team at Change. Tom, if you want to start sharing your screen. Yeah, I can see the cover slide now. Tom, Tony, you can take it away.
Okay, perfect. Thank you, Mark. Good morning, all. Tony Sheehan, CEO of Change Financial, joined, as Mark said, by Tom Russell, our Executive Director. We'll just go through some slides today, which is an update on our business and our recent results, and then we can take Q&A. So the first slide I thought we'd start off with today is what do we do at Change Financial? So we provide innovative and scalable payments solutions for over 150 clients across more than 40 countries. So we are a B2B business and we have 2 core products. The first one being Vertexon, which is our payments as a service offering. So this provides card issuing, card management and transaction processing. Vertexon generated 72% of the group's revenue in FY24. The second of our core products is PaySim. PaySim is software which enables end-to-end testing of payments platforms, processes, and scheme rule compliance. And PaySim contributed 28% of the group's revenue in FY24. And as a business, we are focused on growing both of our core products. With Vertexon, which is the majority of our revenue, it's probably just worth going into a little bit more detail around that to add some more context. So our role in the payment process depends on the region, the client type, and the services we provide. So there are 2 main options for what Change can do with Vertexon. The first one is processing. So we're really providing just the technology to enable card issuing, but the client is responsible for card issuing. So the client holds all the necessary scheme. Typically, globally, that would be Visa or MasterCard. card and the necessary regulatory licenses in the different jurisdictions. You've got to have the appropriate regulatory licenses to be able to issue cards. We're not talking about issuing cards. That's issuing your physical cards, the cards that are in your wallet, and it's also issuing digital cards that are on your phone as well. The second option is processing and issuing. So under processing and issuing, Change provides the technology to enable card issuing, but we are also responsible for the card issuing. So in that scenario, we hold the necessary scheme. We are a MasterCard shop, and we hold the necessary regulatory licenses in Australia, New Zealand, the US. So in Australia, we have an AFSL. In New Zealand, we are a financial service provider. And in the US, we have a sponsor bank. Thanks, Tom. We'll move on to the next slide, please. Okay, so the key highlights from FY24. So record revenue year for the business of $10.6 million US dollars. So all our numbers we report in US dollars. So please bear that in mind as we go through the presentation. So that was up 22% on FY23. Really, the growth has started to come through materially in the second half of the year, with revenue up 39% on prior year. That's on the back of the launch of our Vertexon platform, where we are processing and issuing for the clients. So we've done a lot of work, a lot of investment over the years in our Vertexon platform, and also to get our operational capabilities and licensing. We are now live and operational in Australia, New Zealand, and the US for card issuing. So we're now starting to see the volumes and revenue growth coming through from that side of the business. So we've got more than 40,000 cards on the platform, active cards on our platform. So active being transacting cards. 59% of our revenue came from recurring income streams throughout the year. Our recurring income, we really treat as support and maintenance on our software, plus our transactional fee revenue, which is sort of recurring on a month-to-month basis as well. We processed 2.2 million transactions in FY24 for a total value of $71 million. Those numbers really started to ramp up in the late months of FY24. We're still seeing that growing and that strong growth. So you'll see those numbers in FY25 and beyond materially higher than what that number is, considering FY24 was the first year of us undertaking processing and issuing. We had $2.6 million of cash at 30th of June and another $500,000 of cash-backed security guarantees, which is a requirement really of our scheme partners as part of our card issuing. In terms of financial results, just very quickly, we have a very geographically diverse client base. So that does provide us with that platform for future growth and expansion. I've talked about that revenue for FY24, that record result there, up 22%. You can see on the right-hand side, the revenue by quarter really starting to accelerate in the back half of FY24 as our clients are migrating across to our Vertexon PaaS platform and issuing cards, and the volumes are starting to process through. In terms of revenue by region, you can see down the bottom left there, strong representation from Southeast Asia and Oceania. We would expect that contribution from Oceania to be even stronger in FY25, particularly on the back of some of our material clients that we have won and that are processing on our platform. Tom will run through some of those later on in the presentation, but we have some large financial institutions, including two of the largest credit unions in New Zealand that are on our platform, plus other financial institutions as well. In terms of revenue by service offering, you can see in FY24, that little orange part of the donut there, which is our processing and issuing revenue. The first year that we've been generating that processing and issuing revenue that I've been mentioning, we would expect that contribution from our PaaS solution or our processing and issuing to really increase materially in FY25 as well. From a P&L perspective, so there was a material EBITDA improvement, and that's really been driven by revenue growth and a stable fixed cost base of the business. So if you have a look at that, FY24, we've narrowed the EBITDA loss by 42%. And if we have a look at it on a half-by-half basis, the second half of the year was EBITDA neutral. And as I said there, the revenue revenue growth is coming through. You can see that OpEx in the business stable as well. So we've scaled up the business to where we need to be in terms of our compliance, treasury, fraud management functionality to ensure that we can service our clients. It's now really about scaling the business, driving that profitable revenue growth, and moving into an EBITDA positive territory as well. The only thing I'll just call out on the P&L now that we are processing and issuing, so our card issuing business, there is COGS that we have broken out at the top there, and that's primarily scheme and connectivity fees. So when I talk about scheme, it's really MasterCard or domestic EFTPOS fees when they're processing our cards on their rails. So we would expect the volume-related component of our COGS to increase as our PaaS client numbers and volumes increase in FY25 and beyond. But the increased volume will deliver scale benefits because there is a portion of our COGS which are fixed, and that's typically those sort of connectivity fees. You can see that in FY23 where we had the connectivity fees, but no real PaaS revenue. Now that we're generating the PaaS revenue in FY24, the delta in those COGS is really from our volume-related fees as well. Next slide, please, Tom.
Thanks, Tony. Okay, I'll jump into a few operational highlights here, particularly around our PaaS business. So this next section is more focused on our PaaS offering in New Zealand, Australia, and the US, where we're seeing that material growth. So FY24 was a very formative year for us. We launched our first PaaS clients on the new platform. As of today, we have 9 clients live, a number of credit unions in New Zealand and fintechs in Australia, New Zealand, and the US. As Tony said before, we've got over 40,000 cards now, active cards on the platform. A lot of those are from our credit unions, our major credit union clients, and Unity Credit Union went live this weekend. So that's the second biggest credit union in New Zealand. They went live on the weekend. They're rolling out 20,000 cards this week. We expect to keep seeing these numbers grow, as Tony said, and FY24 with our clients weren't at run rate, and in FY25 they were, and then Unity's gone live as well. So we will see a material uplift in transaction volumes and transaction value, which we'll talk about the revenue a bit further, but that's really what drives our PaaS revenue for us. Just some of the key things we achieved in FY24. I'm not going to go through all these, but if I break into a few sections, as I said, we launched our first PaaS client, so we really set the foundations. We got the platform live. We launched those first clients. We signed some new clients in the back end of the financial year as well, so we've got good momentum going into FY25. But if the first part of the year was really forming those foundations, in the back end, we signed Unity Credit Union, another major deal for us. We signed a major project with one of our existing Vertexon on-prem clients in Southeast Asia to roll out credit cards. So we do all the processing. They are the issuer. We do all the processing for their prepaid cards, millions and millions of cards, and they're rolling out credit cards to their client base now. And we also hired a chief commercial officer. So we're really signaling here that the business is moving from the technology build phase and into the commercialization phase. The other thing I forgot to mention was Unity Credit Union on the weekend was our first client on the PaaS platform to go live with Google Pay. And the rest of our clients will go live in the coming months with Apple Pay to follow shortly thereafter. And that means more revenue and increased margins for us, depending on the take-up of those digital pays. And there's just at the bottom there's a few cards. You can see those cards are for our credit union clients and our fintechs, and they're all issued by Change Financial. So on the back of that card, it says issued by Change Financial. Operational excellence. So FY24 as well. We've also, as Tony talked about before, the stable cost base. We put in place our key functions in the business that we need for growing our PaaS business. So treasury, fraud, compliance, onboarding. Those teams are in place. We've been incurring those costs for a little while before the revenue went live, but the great thing is now we'll just refine that over time. But those teams are in place and capable of adding new clients. So when we won Unity Credit Union, we didn't hire any more staff to onboard them. We plug it into the platform, the existing teams onboard them, and there's a fair bit of headroom in there to grow the business over the next 12 to 24 months without adding material costs. And then market-leading solutions, as I said, we've rolled out our digital pays, and we're going to continue to invest in our platform. A big part of our CapEx is done in FY24, and we expect that to moderate, but we will keep investing in new features and improving the platform over time. All right, we'll go into some outlook. I'll just talk to the revenue, where revenue is going in the first instance. So on the left there, you can see our FY23 and FY24 revenue and that sort of record year that Tony talked about. The big difference and the key point on takeaway on this slide is the real difference on where we're starting from the beginning of the financial year now that our PaaS platform's live. So that dark blue navy box on the left there, inside the bigger orange box, that's our support and maintenance revenue. Now that is recurring annual revenue that our on-prem and our PaySim clients in particular pay every year for scheme updates and for us to support our technology that they're running. The big difference this year is we've also got our PaaS platform live. So where we started FY24 with a little bit under $5 million US of contracted recurring revenue, this year we're starting with more than 10 million in terms of our already onboarded New Zealand, Australian and US PaaS clients, but also Unity that went live on the weekend. The other part of our revenue is our license and project revenue. So license is a new sale to an existing Vertexon on-prem client for a new feature or functionality, or a new PaySim license to a new client or a new module to an existing client. And then project work would be for an upgrade. So project revenue came from that Southeast Asian client we talked about who upgraded to credit cards. We put resources on that. We help build out our platform to support credit cards for them. And over the last 3 years, we've done between $3 to $4 million US of revenue. We do have to top that revenue up every year, but the existing customer base and the team is already in place to support delivering that revenue. Pass it back to you, Tony.
Thanks, Tom. So last week we announced a capital raising, and that capital raising was really to support the growth in our business and strengthen our balance sheet. So in terms of the offer, we're raising up to 4.25 million Australian dollars. We've done a placement for 3.5 million. That was all binding commitments we received for the placement, very strongly supported by both new and existing institutional, sophisticated professional investors. So that was really pleasing for the business to see the strong demand in terms of where we're heading for the business as well. We're also doing a SPP for 750,000 Australian dollars. So that will provide the opportunity for all our existing shareholders to participate in the capital raising. So the proceeds from the capital raising, what are we using those for? There's really sort of three key items. One is the working capital cycle support. So as we've talked about, we've seen a material increase in our PaaS volumes and hence revenue, which is driving an increase in our volume-related COGS. So we're incurring and paying these COGS daily before we receive the invoice payment from our clients, which is monthly in arrears. So that's creating that sort of drag on our working capital. It's not a P&L issue. It's just a timing of that sort of cash flow coming in. The second element is security collateral. So we've seen that uplift in the volumes that has resulted in an increase in our required scheme collateral. Now, moving forward, this requirement will be mitigated through client funding of collateral, and that's what we've done with Unity Credit Union, where they're funding the collateral required there. But we do have that increased collateral requirement for some of our existing clients and volumes that are on the platform. The third element there is really to support our growth opportunities. So with the PaaS platform live and operational in all our three target markets of New Zealand, Australia, and the US, and processing material volumes, that referenceability is driving key growth opportunities. So we always talk about in our business referenceability. You can point to clients that are using our products and services, which helps in that sales cycle, helps to move opportunities through that sales funnel to close as well, because they can gain confidence from the other clients that are using our platform as well. So in essence, really that capital raising strengthens the balance sheet and supports our growth ambitions, particularly as we're scaling rapidly. So in terms of the outlook here, so with the PaaS clients now on board and contributing material revenue in FY25. We are targeting revenue growth in excess of 30%. So Tom mentioned it before. This is now underpinned by a significant portion of contracted revenue and the increasing number of PaaS clients that we're onboarding, which is driving transactional revenue. That underpinning of contract revenue really moving from sort of that base of 5 million to in excess of 10 million, and then we continue to build and grow the business from there on. In terms of the bottom line, we're increasing our operating leverage. We are targeting our maiden EBITDA positive result in FY25 as well. So really, we have 4 key objectives to drive our success. Each of these objectives in our business has a number of key initiatives which the team focuses on and prioritises to deliver. Those objectives, similar to what we had in FY24, accelerate growth and scale, our operational excellence, market-leading solutions, and powering our people. It's key to focus on our people as a technology business. Our people are key to the development and growth of our business and the support of our clients as well. So just I'll leave it on this on this slide in terms of investment highlights. We've got the building blocks are now in place. So as I mentioned, we do have all the necessary regulatory and licensing requirements for our card issuing in New Zealand, Australia, and the US. We're entering that growth and scale phase. We have been through a period of significant investment in our products, particularly on the Vertexon side of the business. We're now really into that commercialization phase, growing that revenue, but growing that revenue profitably in the business. We have appointed a chief commercial officer. Really, that focus is moving away from that sort of really heavy product investment, more towards commercialization. As Tom said, we will continue to invest in our products and services there, but we're really focusing on driving that growth and commercializing the investment we have made in the business. We've got marquee customers, as we talked about. We have the 2 largest credit unions in New Zealand, plus another 3 credit unions using the platform in New Zealand. We've also got fintechs that are onboarded as well. We have long-term relationships with 2 of the largest banks in the Philippines. They run about 40 million cards on our platform. And on the PaySim side, we've got 5 of the top 10 digital payment companies that use PaySim for their payments testing. In terms of product offering, we've got our 2 core products, Vertexon and PaySim as well. So excellent technology. We'll continue to invest, as we've mentioned there as well. I should say on the PaySim side, it says there, it is the default standard for FPOS testing in Australia. So any company, any payments company that wants to join the FPOS network in Australia must use PaySim for their certification. We've got our long-term contracts, so we've typically got 3 to 5 year contracts with our key clients. A lot of our clients have been with us many, many more years than that, so we've got a sticky client base as well to help with that growth. And then finally, we've got those market tailwinds as well. So there's that move towards digital payments as cash usage declines. And there are those barriers to entry to become a card issuer, to get the necessary regulatory licenses in place and the scheme licenses as well. There's a lot of work and investment that it takes, and also in the people to make sure we can operationalize that side of the business. Okay, that's it for our formal presentation. I think we're just about on time there.
Yep, thanks very much, guys. And questions have been flying in here, so I'll get straight into them. First one is on new client pipeline. I'm guessing, these are enterprise sale types of agreements, so they are kind of, a long process with a lot of regulation and compliance and testing on both sides. But anything you're expecting or in the pipeline that, could be coming through in the next 6 to 12 months?
Yeah, so look, on the sales pipeline, we've got a healthy sales pipeline across our target markets, and in particular, including, I should say, in Southeast Asia. We're seeing that sort of interest in our products and services continue to expand, particularly in Australia, New Zealand, and the US. Now we're live. We'll be focusing on bringing some of those bigger clients through to the pipeline, through the bottom of the funnel and signing those. But we don't really sort of give guidance in terms of expectations for client wins. But I think what we're continuing to focus on bringing on those new clients, the ones like Unity. We want to continue to bring them on and expand that outside of New Zealand, where we've had a lot of traction, and really get that into Australia and the US as well. So with the Chief Commercial Officer in place now, I think that sort of marks our intention of really focusing on delivering those sort of key client wins.
You mentioned Unity there, so leads in nicely into the next question. In terms of the business development process, did you beat out another competitor to, get Unity on board? Or were they an existing client and they, came back to you guys and say, hey, we want to do X, Y, Z. Can we, take on the PaaS offering? And it was just a case of then implementing. Maybe just talk through how the Unity deal came together.
Yeah, Tom, do you want me to take that one?
Sure, mate.
Yeah. So for Unity and our other existing financial institution clients, so First Credit Union, the biggest credit union in New Zealand, Unity is actually, I think, the second biggest credit union in the country as well, plus the other financial institution clients we had, they had existing card programs, so their members are using their cards. We have won those clients away from competitors of ours. Really, the points of differentiation for us is firstly is products. So our product capabilities, we're rolling out, I think, as Tom mentioned, the digital pays to these clients. They have never had digital pay capabilities to offer to their members. So what a lot of people would take as sort of fairly standard in particularly in Australia, where you've got your digital wallet, which has your debit card or credit card or whatever card that might be that you use. They've never had that sort of product offering. So we're taking really our product and really enhancing the offering that they can make to their cardholders as well. And the second part of that was our service offering as well. So we've got a very highly skilled team that's across fraud management and treasury and onboarding as well, really offering that holistic service offering. So it's a product and service offering differentiation that we're sort of winning in market. So they are wins against direct competitors because they had existing programs. That's also what drives that immediate burst of volume that comes onto us. It's not a scale up unless they're doing a staged migration of cards. But we see with like Unity that Tom mentioned, they've cut over on the weekend. Their volume now moves 100% for their debit cards over to Change Financial.
Okay. And then the next one then is you're talking about Google and Apple Pay being a bit more margin for you guys, and the question is around how is that achieved? Is it because you're adding functionality outside of the the basic MasterCard and Visa processing? Is it like extra fee that's carried by, say, like Unity or one of the others? Maybe just talk about how it ends up with more margin for you guys.
I'll take that one, Tony. So Change is a pure enterprise business or B2B business. We do not contract with the end cardholder. The cardholder is the customer of our client, being the credit union or the fintech. Sorry. With the rollout of the digital pays, that is a service that, as Tony said, they've never had through their existing providers. And the credit unions, for example, or the fintechs, have decided they want to offer it to their cardholders. So they are the ones that pay the additional fees for the transactions that go through that mechanism. As Tony said, we're not sure exactly what the take-up's going to be because these clients, these cardholders have never had it before. So we're quite excited to see how that works as well. But we're a B2B business, and the credit union, as an example, is the one who's paying for that service. Whether they decide to on-charge that like they might for an ATM or a certain type of transaction, that's completely up to them.
Okay. Another one here, just on credit risk and collateral on the issued cards. I guess the issued cards from your side in the Vertexon business. Maybe just touch on that quickly.
I can take that one too, Tony. Credit risk on cards issued, we are not taking any credit risk. So the credit cards that have been rolled out on our platform in Southeast Asia, the bank in this instance is the is the issuer. They're the ones who do the credit checking. They fund the credit. We are a software or a technology provider that allows them to do all those things. Same as for debit cards. The debit cards, well, there's no credit on them, obviously, but those are the cardholder funds. They sit in that credit union. We check balances. The transactions flow through the system, but the cardholder is paying for those. In terms of collateral, the collateral, I'm not sure if it was mentioned before, but that is a mechanism that the card schemes require us to hold. It's based on a volume amount. As Tony did say, Unity Credit Union is funding their own collateral. So the collateral piece of the puzzle we've had to solve is for those initial clients that have gone live. But going forward, Unity fund it themselves. Our new clients will fund their own collateral.
Okay, perfect. And then this is a kind of a specific one on the US. In terms of your US clients, Plutus M or Virtual CC, have they gone live with their card offering? I understand they were targeted to go live in Q1 of this financial year. Maybe just touch on where they are in their kind of rollout process and take up.
Yeah, so with Plutus M and Vert CC, they are live, so they are operational and fully live and operational on the platform in the US. In terms of their rollout, that really falls into what their plans are to roll that out. They're working through the onboarding processes with cardholders, making sure that it fits in terms of the US regulatory environment as well. So that's always a move. It's a different environment in the US. So both those clients are making sure that they can fit within their onboarding processes, fit within compliance and regulations there, and then will roll out at their own sort of velocity. So from a platform perspective, they are onboarded. They have live transactions that have been processed. Then they take that from there in terms of rolling it out further to a broader audience.
Okay. Gentlemen, thank you very much for coming in and joining us. It's been good to hear the story firsthand, and hopefully we can get you back in at some stage in FY25.
Thanks, Mark, and thanks everyone for joining.
Thanks, Tom.
Thanks, Mark. Thanks, everyone. Appreciate your time.
Tom, if I could just ask you to stop sharing your presentation, and we have joining us once again is Tony Abrahams from AI Media. Tony, if you want to start sharing your presentation, I'll let you know when it comes on screen here.
No worries. Hopefully I'm sharing the right screen.
You are. I can see the cover slide of your results deck now, Tony.
Excellent. Thanks very much, Mark. Great to be here, and thanks to a lot of our well-known shareholders who are on the call. I am delighted to really run through what is a breakthrough set of results for AI Media. We turned 21 last month, and for the first 18 years of running AI Media, every single workflow that we did required a human in the loop. So again, we do live and recorded captioning, transcription, and translation using AI tools. And we've been using these AI tools since 2003. But the AI tools that we were using for the first 18 years still, as I said, required a human in the loop. And that human in the loop for live captioning was someone that we called a re-speaker. And what we did is we had that re-speaker listen and repeat every single thing that was on during a shift. And they are repeating this into a speech recognition engine that they have trained using AI and machine learning over hundreds of hours to their unique voice print. And this was a workflow that continued for, as I said, 18 years, which is an incredibly long time. In 2017, in mid-2017, AI Media were the global launch partners for live captioning on Facebook. And as a result of that, we were very, very heavily involved with the Facebook developer community in the F8 community conference, setting. And I remember being there in 2018 and on the second day and hearing a plenary after lunch from Facebook's then head of AI. It was a 90-minute session in early 2018. And it really foreshadowed very clearly for everyone in the audience what was coming in terms of the Gen AI revolution that we've all seen today. And it was talking about the hidden Markov models. It was talking about the ability for data that is machine learning, that is corrected data, that is training data, to have 10 or 100 times the impact 2 or 3 years hence than it did at the time. And all of that has come to bear. And so really, ever since starting AI Media in 2003, I've actually been waiting for this particular moment, which is the moment when we can truly become a technology company. And the Gen AI revolution is what has allowed that. So I'll just run through, Mark, a little bit of the results, and then talk a little bit about the business model, why it is so important that we have the encoding technology, ICAP, and Lexi to deliver the technology solution, and what we see going forwards and where we see the expansion, and then I'll leave plenty of time for questions. So really, I think the thing to call out is that when we knew that the era of the re-speaker was coming to an end, and that you could design a solution that was a technology-only solution, and remember this back in 2018, the question then is, how do you design that solution? And what we did is we acquired New York-based EEG in 2021, and that company effectively has the same product and technology mix that had been dominant in US broadcast. 80% market share in US broadcast. When we acquired EEG in 2021, they had US $8 million in annual revenue. Today, 3 years later, that exact same marketplace, North American technology sales, we wrote 32 million Aussie in revenue 3 years later. So while overall you might look at the progress from FY22 to FY24 and think, well, the revenue hasn't grown that much. Actually, it's the story of two businesses. It's that legacy human in the loop business that we're calling the services business in black, that's been shrinking. Those margins are in the low 40s, and the technology growth, which has been growing in the high 30s, and that revenue, that margin is is greater than 80%. In fact, 85%. And so what we're really saying now is that, with half of our revenue in the whole of FY24 being technology, we exited FY24 at a much higher than 50% rate of technology sales, and we will have less than 20% of our business being legacy human in the loop services by December of 2025. So effectively, that black component there will reduce to no more than 20%. In terms of the financial highlight, as I said, total revenue up 7% because of the 37% growth in tech, and the 12% fall in services. Gross margin up 4 points, tech gross margin up 1 point, and EBITDA up 24% to 4.1 million. I think it's worth also pointing out the transformation journey that we've been on over the last 3 to 4 years has really seen a very, very, very significant turnaround in profitability. In 2021, we had revenues, and that was before the EEG acquisition. We had revenues of $49 million and an EBITDA loss of more than $9 million. In 2024, 3 years later, we've got revenues of $66 million and an EBITDA profit of $4 million. At the same time, we've shed hundreds of staff. We're down to 400, and I would expect that to be in the 300s very soon, as we replace a lot of operations humans with technology, and the investments that we're making in our team are no longer about delivering individual sessions or individual appointments and translations for customers. It's actually now about making sure that we've got the right salespeople, the right sales resources, the right marketing effort, and the right product and engineering team to continue to harness the growth opportunities that we see. And in short, we have done this funded through operating cash flow. We've been cash flow positive now for 3 years. We have spent a considerable amount in taking what is this unique ecosystem that we effectively inherited from EEG, and we are expanding from US broadcast in 3 different directions. So this exact same workflow here, where effectively it starts with the encoders. So those encoders encode the audio and video from the customer's audio-visuals output from their playout system. So we are directly embedded in the workflow of our customers. We are receiving all of the audio-visual information that is being generated by the customer. And what that means is that we have the ability to read that data, not just the audio, not just the video, but also what they call the metadata that goes with it. And that metadata actually has really important information that allows us to design automated signaling and switching solutions for broadcast customers. So, for example, in that broadcast stream, it contains commands and knowledge about when an ad break is. If we already know when an ad break is, we can turn the captions off before the ad break starts. If we don't have that automation sequence, then we have to pay a human to do it. And these are some of the opportunities that we're now seeing to further improve the automation in the system. The third point there in terms of delivering the real-time captioning that's so important is the ICAP network, which connects all of the encoders to each other and connects all of the encoders also to the ICAP cloud. On the ICAP cloud is where we put the AI translation and transcription engines. So the workflow takes the video input from the customer, uses one of our encoders. Those encoders strip out the audio and the metadata, and they send that information up to the ICAP cloud in a fraction of a second. And then the ICAP cloud contains the commercially available AI engines, and we have dozens of them. And it also contains a link to the metadata or contextual information from the customer as to what it is that's being captioned or transcribed. So, for example, Sunrise on Channel 7 in the morning is actually 133 different program segments. Each 133 of those could be traffic in Brisbane or sport in Adelaide. All of them have their own unique dictionary sets or topic models. And what Lexi does is it automatically reads the media asset management system of the customer, understands what the topic model is related to that particular segment, one out of 133, and effectively automates and cycles them in and out, which is an essential component to get the level of accuracy that we've seen with Lexi 3.0, surpassing humans this year for the very first time, and of course, at a fraction of the cost. In terms of the 3 elements of the EEG business, they remain the same, and they are now the core of the AI media business. It's world-leading captioning network infrastructure and solutions. It's a family of encoders that we're continually adding to, because it's not the encoders that make us the money. It's actually the SaaS services that go over the top of that. So it's the ICAP and it's the Lexi toolkit. And so in terms of what we want for encoders, we want those encoders everywhere. And so we're looking at building new SKUs, getting more manufacturing capability, looking at really innovative design opportunities so that we can begin to tackle markets that sit outside of a traditional broadcast environment where EEG has traditionally been very strong. This is a great glance at where we finished FY24. And I actually just got back from 4 months in the US, where I was seeing all of those customers there on the left multiple times, because really it's been an America first strategy for us. EEG had great market presence and brand recognition in the North American market and zero sales outside when we acquired them 3 years ago. What we are trying to do, as I said, is we're looking to replicate the success that we've had in US broadcast. And keep in mind, we've taken US $8 million to be Aussie $32 million in 3 years. So I call that success. Look at the brands there that we've engaged with: Disney, ESPN, Google, NBC, Paramount, NBA, the NFL, Netflix, Telemundo, Fox, Warner Media. These are all the big brands. We have a greater than 80% market share in the captioning market in North America in terms of encoding equipment. And when we acquired EEG, they had a 16% share of the total captioning market that was delivered with Lexi. And that Lexi volume was less than $1 million. Oh, it was less than $1 million US. It was $1 million Aussie. And you can see that today we are well above 10, and we're going a lot faster. So the mix in terms of the EEG revenue 3 years ago, it was 90% boxes. It was encoders. It was hardware. Today, it's about 2/3 actually SaaS, and we want that to continue to grow. And as the Lexi quality continues to improve, more and more customers are switching that Lexi on for longer and longer. And we'll see that as we go through the graph. It's taken 3 years to really design and tweak the encoding solutions to work as effectively outside of North America as they do in North America. And the good news is that a lot of that development work is now in the rearview mirror. Last year, we spent $7.5 million on our product and engineering teams. Only 300,000 of that was capitalized. So you know, we've been very, very conservative in terms of our accounting treatment here. But we added 50 new countries last year, 50 new countries that can support the ICAP encoder family. And recall that's up from just 2, US and Canada, 3 years ago. So we're very excited. Also, we delivered the Olympics with Lexi, both in North America and in Australia, in English and in Spanish. And off the back of the success of that, we're also now accelerating the technology transition for the APAC customers. And that's Foxtel, Channel 9 and Channel 7, who are the big groups that remain on some of the services revenue. And then what I also wanted to highlight here was the segment. So fully 62% of our revenue last year was broadcast. At IPO, 64% of our revenue was enterprise. So we've really fallen back a lot relatively in terms of enterprise and education universities. This is going to be also a major focus for us in the years ahead. I said it was US broadcast first, but then we're looking to expand geographically into EMEA and APAC, and we're also looking to expand the segments. So go from broadcast to government and to enterprise. Government, obviously, much slower than commercial organizations, so you would expect that. The commercial organizations on the left are saving 80 to 90% of their costs by switching on Lexi. So this is the substitution sale. They are turning off humans and they are turning on the Lexi technology. It's a very easy sale. And that's why we've seen the massive acceleration in that sector. What we expect to see going forwards is government pickup. And we do believe that the size of the government opportunity and the size of the enterprise opportunity globally are about the same as broadcast. So there's a lot of room to grow. So they're two of the dimensions that we're going to grow in, regionally from the US into EMEA, into APAC, and then from broadcast into government and into enterprise. And then what we're also going to do is we're going to continue to launch more products through the Lexi Toolkit. At the moment, between 80 and 90% of everything AI media does is live captioning. But live captioning is less than 1% of the total AI-powered language services market that we see moving over into AI in the next few years. And that's a really exciting growth story for us, and it's one that we can fund organically. In terms of the regional breakdown, I mentioned that it was America's first. That's where I've been spending my time. They're the customers we've been speaking to. Fully 74% of our largest segment, being North America, is already technology. So when I say we're going to be at 80% by December 2025, there are some runs on the board that suggest we're going to be there. And as I said, we're going very fast already in APAC and EMEA. But the key thing around EMEA is it's obviously got a very low top line revenue number at the moment. So growing that revenue number out, having got the extra 50 countries to work with the ICAP network is a key focus for FY25. I will skip over some of these, Mark, just in the interest of time, because I do want to take questions. So you can see there that the ICAP and Lexi usage has grown very, very strongly since we've owned EEG. I said, so these are in terms of minutes. In FY21, the very first year we acquired EEG, we were only doing 9.7 million minutes across the year, and now we're doing 53.3. And of course, the network itself has grown from 70 million to 116 million at the time. So it really does show that the hypothesis that we had 3 years ago really has happened and is continuing to happen. And thanks to everyone for being there on the journey. And yeah, happy to take some questions.
Thanks, Sonny. Yeah, questions have been flying in here, so hopefully we can get through most of them. First one we'll take is hardware sales were 39% of tech revenue. Is that an indicator of future new client revenue growth? Is it they take on the hardware and then it naturally leads into feeding into the Lexi cloud down the line?
Yes, there's only one reason to buy the encoder, and that is to get access to Lexi. So the encoder is a $10,000 CapEx purchase, but Lexi can be $25,000 a year ongoing, or $50,000 a year ongoing, or $500,000 a year ongoing, depending on how many channels the customers have. Typically, it's probably around the $25,000 a year mark for a single channel.
Okay. And then we'll stay on hardware for a second. Gross margin on the hardware sales, is that, a significant contributor to profit, or is it, we won't make much money on the hardware side, we're more interested in just getting encoders into customers' hands, and then we make it up obviously on the Lexi SaaS side?
Yeah, look, we were very fortunate in the sense that when we bought EEG, 90% of its revenue was still hardware. And so it was very focused on cost control, on efficient manufacturing. The manufacturing is done in-house in our facility in Farmingdale in Long Island. And it's very good. But we produce like 1,000 units a year. Now, the question is, okay, we make some money on selling 1,000 a year, and the margins are probably around between 70 and 80%. So they're pretty good in terms of what you would see in the industry in terms of hardware margins. But I think you've hit the nail on the head, Mark. The real key strategic driver is getting as many encoders in place around the world as possible and getting the ICAP network on those encoders so that we can continue to sell annually $25,000 a year rather than worry necessarily about how much profit we're making on a $10,000 box.
And yeah, let's just stay on EEG. Is there an EEG competitor in Europe you need to displace in order to get your encoders in there, or can the EEG encoders equally work as well in the UK as they do in the US?
They do now work as well in the UK as they do in the US. And the situation in other territories around the world is that there is no direct competitor to EEG, in the sense that there is no other company that has the technology map that does the encoding and ICAP and Lexi, reading the media asset management stuff embedded into the workflows. Of course, there are companies that do encoding of the audio, and there are companies that do encoding of the captions back. We've listed those: Enco, Evertz. There's a bunch of players that do that. If someone wants Lexi, if someone wants the benefits of this automation to decrease their cost by 90%, they need to make sure that they've got a workflow solution that looks at all of the data that they're pumping through the pipe, being the AV pipe and the broadcast pipe. And only our solutions are currently designed for that.
Okay. Question on, did the take-up of the disaster recovery units launched in the second half of the last financial year meet expectation? Is this a prospect for material hardware sales from this new product line?
Great question, Stella. So we only launched the disaster recovery units at the end of April. And so we only really had 2 months to ship those units. So it was an early, I think we've done sort of 70 of those units or something. As I said, out of a total of sort of 1,000 for the year. We do expect this product line to grow strongest this year, because this product is the final piece of the puzzle that allows our customers to switch off the dependency for humans in the loop as a backup solution. So if the internet goes down, currently the solution is that you have captioners using dial-up modems who dial into these encoders and then receive the audio in that very 1995 way. What our new Lexi DR box does is it incorporates an AI NVIDIA chip in a local device. That local device sits with the broadcaster, but that local device also has a connection to the internet. And what that connection to the internet does is it syncs the local device effectively with the cloud device. So it's effectively mirrored, and it always knows, it's got the same information. It knows where everything is. And then when the DR box, the disaster recovery box, loses connection to the internet, it assumes the entire facility has lost connection to the internet, which is often the case, and it just takes over from the local device. And with the 50 boxes that we've got in the field at the moment, they're all working very, very well, and this is critical to helping us get to the 99.999% uptime. At the moment, we're at 4 nines. When we inherited ICAP, it was 99.8. So we've done a lot already to get this enterprise grade.
And let's hope the clients are not like some of Optus's clients. We had a little over a year ago when Optus went down and their backup network provider was also Optus. So let's hope they've figured out they should have 2 networks and one connected to disaster recovery.
Well, exactly. No, you're exactly right. And there's, I mean, the second you're relying on the internet and then the internet goes out, you're stuffed. So you actually need a solution that's local. It was very interesting. I mean, at the NAB conference this year, it was very interesting to me that this move that sort of 2018, 2019, it was cloud, everyone cloud. In 2024, the contention in the internet, because there's so much being pumped through it, and the infrastructure just hasn't kept pace. There are brownouts on the internet now that are going on much more frequently than they were years ago, and everyone needs an on-prem backup.
Yeah. Or the latest CrowdStrike patch update, another example of why you need a DR box. Amazon as a client, I'm not sure if they're coming at this from, you know, their Twitch business, or you know, what would, you know, where would Lexi fit into Amazon's ecosystem?
Oh, look, Amazon are a critical customer of ours. We engage with Amazon in a number of different levels. Probably, you know, the question around the strategic nature of Amazon. So you know, we do captioning and Lexi captioning for Prime, and you know, we caption you know, the football games and so on that are on Amazon. But actually, what's interesting is the AWS subsidiary that acquired Elemental. This business unit within AWS has partnered with AI Media officially, and next week we will be at the trade show in Amsterdam, where we will have AI Media, Lexi, and Alta branding on the AWS stand, in order to help AWS win customers that frankly require this Lexi solution in their workflow. We've done similar deals with resellers like Vivero and integrators in Asia as well. And I think really what we're looking at is we're really looking at this is a scalable product, right? These products are scalable and they work. We just want to get these out in front of as many customers as possible, as quickly as possible. And so we will look at every avenue to do it: direct, indirect sales channels, partners, distributors, and great brands like Amazon.
Tony, we're just up on time, and apologies to people I didn't get to your questions. So it was just a flurry there right at the end, and we've just run out of time. But we will endeavor to get Tony back on again, although he does travel to see all of his customers. As he said, he was 4 months in the US, but we will try and find a gap in his schedule to have him back. Tony, thank you very much for joining us once again, and yeah, we'll keep following the media story via the ASX. Thank you.
And thanks, Mark. And I'll answer the questions we didn't get to in the chat.
Okay, perfect. Thank you so much, Tony.
Thanks.
Allan, if you want to, sorry, let me welcome properly here, Allan Savins, CEO of BNK Banking Corporation. Good morning. Allan, if you want to start sharing your preso. Yes, I can see it now. And I just want to give an update to the audience. This presentation went live on the ASX this morning. So if anybody is looking at it, you can get it on the ASX announcement platform now or after Allan's finished. But Allan, I'll let you take it away.
Thank you, Mark. Good morning, everybody. Yeah, I'm Allan Savins. I'm the CEO of BNK Banking Corporation, and I'm delighted to participate in today's event to showcase the BNK story. BNK operates as a publicly listed Australian deposit-taking institution under the regulation of APRA. It holds an unrestricted banking licence functioning within the Australian financial services sector. And I'm pleased to take you through an overview of the company and the full year FY24 results. Who we are. We're an ADI. We've been operating in the Australian market now for 42 years, writing loans and taking deposits. So to be clear, we are not a fintech. A strategic shift in the business model occurred in September 2018 when the bank merged with mortgage aggregator Finsure and non-bank lender Better Choice Home Loans to uplift and enhance its distribution, underwriting and loan servicing capability. This saw a strategic shift in 2020 with the closure of our 2 branches, and origination became online, predominantly through third-party intermediaries. It's important to note that all BNK loans are currently sold under the brand of Better Choice, not B&K, and deposits are currently sold under the brand of Goldfields Money. Funding diversification was achieved throughout 2021 with the establishment of a Bendigo and Adelaide Bank prime residential warehouse and an off-balance sheet Goldman Sachs specialist residential warehouse. In February 2022, saw the sale of the Finsure business for $152 million, which represented 30 times cash earnings and 2.5 times the book value. So from the sale of Finsure, this has well capitalised the bank and underpinned the expansion into higher margin SME business in August of 2022. In March 23, saw the acquisition of $150 million of higher margin residential loans on the Goldman Sachs off-balance sheet warehouse. As B&K already originates, underwrites and services these loans, and they're already on our system, it made good sense to acquire them when the opportunity presented itself. Given the strong performance of the first tranche of the loans, we acquired a further $80 million in March 2024 from the Goldman Sachs warehouse as well. And importantly, for the second half of FY24, B&K recorded an underlying net profit of approximately $300,000. So that's the timeline overview story of B&K, of where we've come from as to where we are today. So who we are in terms of our value proposition. We are the bank for enterprising Australians. We've demonstrated a track record of lending growth. So the B&K loan book is now at $1.37 billion, with 81% representing prime residential loans. We have experienced strong compound annual growth rates over the past 3 years to 30 June 2024, which I'll be outlining shortly. Importantly, we have a diversified funding base. We have $1.27 billion of customer deposits as at 30 June, with a customer deposit to total loan ratio of 93%, which demonstrates our ability to raise deposits to fund our growth. And our capital adequacy ratio remains very strong at 23.4% at 30 June, well above our prudential and board limits. We have a wider shelf front of products than most smaller ADIs, whether it be prime residential or commercial loans, plus our benefit of the Goldman Sachs off-balance sheet funding line for specialist residential borrowers. This enables our mortgage broker partners to offer a great array of products, or solutions as we prefer to call it, all with the same lender, to attract new customers and help them retain their existing customer base. And our expansion into the higher margin SME market has been made possible due to our existing broker network, which now stands at approximately 12,000 accredited mortgage brokers throughout Australia. So FY24 results overview, our financial results did show an improved trajectory. The challenging market conditions faced by the banking sector persisted throughout FY24, but despite this, our underlying NPAT loss narrowed to $900,000, being an improvement of $600,000 from the previous corresponding period. Further, the second half 24 underlying NPAT was positive at just under $300,000, up $1.5 million on the first half of 24. So of particular note, the second half saw the last 4 consecutive months of positive underlying NPAT. Some other call-outs, our net interest income was up 3% on FY23 to $19.3 million. Our operating expenses of $21.6 million were down $1.5 million on FY23, despite inflationary pressures. So it demonstrated we've remained disciplined with our expense management. Intense market competition on interest rates, combined with changes in the composition of assets and liabilities and rising wholesale funding costs, did lead to a 9 basis point decrease in our net interest margin for the full year, bringing it down to 1.06%. But this decline reflects a trend observed across the entire banking sector. Importantly, the net interest margin for the second half of 24 saw a recovery as foreshadowed at our half year and was up 28 basis points on half 1, 24 to 1.2%. So a summary of our overall performance for the year. So the first column on the left shows our statutory outcomes, our next column our underlying, and our third comparing our underlying FY24 to underlying FY23. So net interest income of 19.3 million was up 3% year on year, as mentioned. Our other income was a net reduction in statutory terms, with the net present value impact on a legacy mortgage management book, which we no longer service, and increased commission expense. In underlying terms, it also reduced due to lower overall fees and higher commission expense across the full year. Our underlying expenses were down 6% year on year, with 199,000 of expenses associated with the start of our phase 2 core technology upgrade. Credit loss expenses for the year of 300,000 was down 73% on the prior year charge. The carrying value of our goodwill was reassessed, and a decision to write down by 3.6 million is reflected in our statutory results. This decision was made through the Better Choice brand, as we are effectively not focusing on prime residential lending anymore. The decision was made to write down that component that reflected the prime residential business. The summation of the above led to a 6.7 million loss for statutory results, a $917,000 loss for underlying, which is a 40% improvement on the underlying result for FY23. Our key metrics. Our balance sheet footing showed modest growth year on year, consistent with our strategic aim of moving away from prime residential loans. A net interest margin year on year reduced 9 basis points through this transitionary period, as I've mentioned. Our underlying cost to income ratio remained flat year on year. Capital ratio improved on both the Tier 1 and total level, and we improved our liquidity ratio, and our net tangible assets remained around $1 per share. Our second half financial results, importantly, was an improvement on our first half. Our net interest income increased by 2.2 million to 10.7 million, up 25%. Our other income also improved, predominantly from high origination fees from the Goldman Sachs off-balance sheet lending program. Conversely, our underlying expenses are up 770,000, or 7% to 11.1 million, largely reflecting increasing technology, professional fees and marketing costs, with half one slightly lower than normal. Our credit provision expense was a small write back as the prime book reduced and our arrears showed signs of stabilising. Our credit model setting remains unchanged across the year. In summary, this led to a positive underlying NPAT in second half 24 of 270,000 compared to an underlying loss of the first half 24 of just under 1.2 million. And importantly, our second half 24, our cost to income ratio reduced to 97%. Our loan book deposits and net interest income. In FY24, the strategy focused on prioritising profitable growth over growth that doesn't meet our cost of capital. As a result, the company shifted away from low margin prime residential loans, consistent with our previous guidance to the market, and concentrated on optimising the loan book composition. And we retained a good portion of our fixed rate loan maturities coming off low rates, and we grew our higher margin assets. So in summary, the loan book held steady at 1.37 billion. Thus, the deposit book also remained stable at 1.27 billion. The last 12 months saw a modest increase in net interest income, as previously outlined, reaching 19.3 million, continuing the upward trend observed in previous years. The growth rate has slowed compared to increases in earlier periods, attributed to heightened competition, deposit customers transitioning to accounts with higher yields, and elevated wholesale funding costs. Our fixed rate loan book provides a continued margin uplift opportunity. We've been relatively successful at helping customers transition to higher variable rates on maturity, with an average retention greater than 60% through the second half of 24, which is broadly in line with our internal targets. The fixed book continues to reduce, and the forward profile shows the maturities over the next 3 halves, by which time we'll have very little left of the resi prime portfolio on fixed rates. And subject to us continuing to successfully retain customers, this should further assist the margin outlook. Our lending portfolio remains stable from a risk perspective. There is minimal variation in the portfolio payment type, with over 80% of loans maintaining the structure of both principal and interest, despite the pivot into higher margin assets. This indicates reduced portfolio risk as borrower equity continues to accumulate. No material change in the portfolio loan type, with a modest increase in investor lending. As previously mentioned, our higher margin assets, which is our new focus, comprises 19% of the portfolio, secured by either residential or commercial property. The goal set 2 years ago was 30% of the portfolio in this cohort over the medium term, so we are well on track to achieve this. So for commercial loans, these are not short-term cash flow loans, but rather traditional term facilities for investment or owner occupation. So a typical loan in that space for an SME is either with a factory or shopper security. We must have alternate use. We don't focus on specialised security, so we don't look, for example, at a childcare centre where the cost to remediate, multiple toilets, for example, is one that drives up the cost of carrying that asset. So we're just looking for vanilla type securities. The specialist residential, effectively they're prime borrowers, just with an alternate source of income verification. So in other words, they may have accountant declaration or BAS statements or bank statements, as opposed to 2 years full financials. And with the shift to high margin lending, the loan to value ratio mix at settlement has steadily improved and remains strong, with greater than 90% of the portfolio having a loan to value ratio below 80%. And our portfolio metrics continue to be healthy. There has been a slight decrease in offset account balances from 89 million to 79 million over FY24, which is consistent with some of the reduction in our prime residential book. Approximately 44% of all loan accounts are still ahead in their payments, slightly down from 49% a year ago. But these metrics continue to provide an effective buffer for our borrowers. Mortgage in possession rates is maintained at zero, together with no credit write-offs recorded during the year. Our fixed rate loans make up 8% of the portfolio as at 30 June, and that portfolio will reduce by a further 46% over Q1 in FY25 and a further 42% over the rest of FY25. In terms of arrears greater than 30 days, our residential loan book stood at 1.64% and our commercial loan book at 0.89 as at 30 June, and I'll talk about that shortly. So in terms of our arrears, the increase in borrowing rates for customers has led to an increase in arrears over the course of FY24. Our greater than 90 days, 30 June, was at 0.79 on our residential loan book and represented 18 accounts. So to put that into context, we've got 3,560 accounts across 2,700 loan customers. The aggregate total for 31 days plus sits at 1.64, which is consistent with the total at December 23, though 90 plus has increased since then, but down from Q3 when the aggregate 31 plus total was 1.76 and 90 plus was 0.97%. Our commercial arrears remain within tolerance, with 3 customers in our 90 days plus category, which is a reduction from 4 as at March. Whilst there were still pressures on households, the portfolio has shown some early signs of stabilising. Our arrears numbers have increased, but they've come off a very low base and are not inconsistent with what we've seen across the industry and recently reported outcomes from other ADIs. We have a very experienced senior management team here at B&K, all with 30 plus years in financial services, myself being over 40 years within the industry, starting off 17 years at a major regional bank from the commencement of my career, 18 years in a non-bank environment, formerly the Chief Operating Officer and Chief Commercial Officer of non-bank lender Resimac. I was Chairman of the Finshaw Group mortgage aggregation from launch in 2010 to December 2015, and were awarded the fastest growing mortgage aggregator in Australia. I've been with B&K for 6 years since the merger with Finshaw, My original position was general manager, and I was promoted to CEO in January of 2022. I have a highly experienced board driving the next phase of growth, which is led by our chairman, John Denovan, special counsel at Dentons. He was the first honorary member of the Mortgage and Finance Association of Australia. Some other call-outs: David Gratian, who was the First Mac board director, and Warren McClelland, who was a non-executive chairman of Resimac Group, associated with Summers Limited, and both of those entities being our two largest shareholders. So in summary, the goal is to deliver sustainable underlying profitable growth in FY25 and build on the second half 24 underlying profit. Importantly, the margin traction gained in the second half 24 provides momentum into 25. High margin assets and higher return on capital opportunities will continue to be the primary area of focus. An essential factor for achieving sustainable profitability continues to lie in the composition of the portfolio. A greater concentration of high margin assets reduces the necessity for a larger loan book to attain optimal profitability. The growth target is to reach 30% concentration of high margin assets for asset mix enhancement. This will be achieved by optimising risk-weighted assets and reallocating capital to support the loan growth. Continued emphasis on cost discipline will be a key driver. The company executed a right sizing of its headcount in the second half 24, which will assist in the strategic positioning of the cost base in 25. The company continues to be judicious with its capital and has no plans for a capital raise in this financial year. Following the repayment of the industry-wide term funding facilities by June 24, the liquidity is expected to normalise through more typical funding patterns in FY25. The company is pleased with the resilience of its customer base amid the challenges of high interest rates and inflation, with approximately 44% of loan customers remaining ahead in their repayments. The company anticipated a rise in arrears from the historical low base, which has since stabilised over the past 6 months. However, it is well provisioned and expects to navigate the challenging economic landscape effectively. The first stage of the technology transformation has been successfully concluded, resulting in increased efficiencies and streamlined internal processes for new commercial loan originations. Phase 2 is currently underway, which focuses on transforming our technology for the larger prime residential portfolio and deposits. And the expansion of the Goldman Sachs off-balance sheet warehouse continues to be an important strategy for boosting the bank's income from sources other than interest. So in conclusion, B&K has made solid strategic progress in the 2024 financial year, despite intense competition and inflationary pressures. Our purpose-driven strategy to focus on higher margin and capital-efficient assets, coupled with disciplined cost control, is gaining traction. We have demonstrated that our emphasis on higher margin assets reduces the need to solely pursue loan book expansion to attain sustainable profitability. So in closing, I thank you for the opportunity to showcase the B&K business, and I will now happily take any questions.
Thanks, Allan. Maybe I'll just kick off the first one. I think when you were on here the last time, the deal for the second tranche of the Goldman Sachs loans hadn't come through yet. If we look forward another 12 or 18 months, is there opportunities for further deals of that nature, be they with GS or with another provider who's looking to exit maybe something in the commercial space that you're trying to grow into, or a specialized residential space? Maybe just talk about where the market is in terms of buying some kind of bulk books from somebody else.
Yeah, it's a great question. We're always in the market to consider inorganic opportunities, Mark. So it really depends on the fundamentals. I mean, we've got our own investment hurdles now that we're looking for from a return on capital perspective. The Goldman Sachs program is one where we sort of play to each other's respective strengths. So we're very good at the origination and the underwriting, the servicing of those loans. They provide the funding for those loans, and it depends on their own strategic position as to what they want to do with those loans. So there's a desire from Goldman's to get their capital back from time to time. If capital markets aren't conducive for a securitisation, for example, that's when we'll have the opportunity to do a whole loan acquisition. At the moment, spreads are looking reasonably favourable in that space. So I dare say governments would want to entertain a securitisation at some point down the track. But notwithstanding, if there is an opportunity with GS, we'll absolutely take it. But similarly, if there are other opportunities for inorganic acquisitions, we'll definitely run the ruler over them for sure. At the moment, the market's pretty tight in terms of assets. No one's really selling, but we are in the market if something makes sense.
Okay. And then just on the fixed rate book, obviously, you know, a lot of it is going to roll off over the course of this next financial year. In terms of your position on fixed rates more broadly, I mean, I'm just thinking where we are in the cycle, you know. Let's say we're at the top now and it's going to start coming off over the next 12 months or so. We won't put you know, a specific date on when the governor might decide she's going to cut rates. But you know, is fixed rates completely off the table, you know, in B&K's future? You know, would you get back into fixed rates at a different point in the interest rate cycle, or are you just going to solely commit to variable rate products across the resi and the commercial book going forward?
Yeah, it is another great question. We don't necessarily speculate on where rates are going, but our appetite is just for variable rates at the moment. So we're not writing any new business onto our balance sheet that's fixed rates. And at the moment, in the foreseeable future, that isn't going to change. I mean, unfortunately, for the borrowers, when they look to fix, the market's already factored in the move. So therefore, fixed rates will generally be higher because of that particular fact. So we don't see a need for them. We don't get requested for them, and it's not within our strategy at the moment.
Yeah. I just want to touch on the capex for the technology upgrade. Can you just give us an idea the quantum of that you're expecting in FY25, and once it's done, should we see a kind of a material drop off in capex in FY26?
Yeah, so we would like to think, and we're moving at our own pace. I'd like to think that the majority of that work will be done in FY25. So yes, I would expect the capex for 26 and onwards to dissipate. We have been provisioning for that initiative for the last number of years. So we believe we are adequately provisioned based on the costs of that particular program to do the work. So at the moment, our costs are well within budget. So we've been planning for this for a number of years now and have been provisioning for some time. So it's a case of when we think is the right time. It's all about just giving customers a better experience. Yes, extracting efficiencies for sure from a back office perspective, that's true. But we are wanting to give customers a better experience at the front end, which is what's predominantly driving this. So as I say, we're well provisioned for FY25 for the work to be done.
And then with the move into profitability, I think you said it was the last 4 months of this financial year. Does that impact then when you go to the market, maybe let's say in 12 months' time, if we see a full year of profitability at the statutory level, does that then change the dynamic in terms of refinancing, warehousing and the statutory subordinated debt? What does the impact of getting to being a fully NPAT statutory profitable business mean in terms of refinancing for the business?
Well, I think it means market confidence first and foremost. So we focus on underlying biggest cash is the most important. As I touched on, we have a legacy mortgage management book. So from an NPV perspective, that's unwinding naturally. So we look after those customers today, but we haven't been originating new loans into that program for some time. So we still have a number of years for that to roll itself off. So that has no impact on our capital apart from just the statutory line impact on us. So I think from again, the immediate focus is on the underlying profit. And it is about building that confidence. I mean, it's about proving a trend. And we have been trending in the right direction for a number of years now. So our underlying NPAT was up 40% this year. It was up 30% last year. So we want to continue that momentum and maintain that, and hopefully that gives market confidence. In terms of our debt instruments and the like, we'll consider those when they're due for expiry. We have no issues talking to our funders, the Bendigo and Adelaide Bank, for example, from the prime warehousing for support. But we think we can raise deposits cheaper, and it's better that we organically originate those deposits and think about the higher margin and higher return on capital opportunities that we want to execute this year.
And then just the expansion into the commercial space. You talked about the 12,000 broker relationships that you've already got. I mean, is it just an education piece with those to say, look, this is a new product offering and we're kind of focused on it. So if you have customers interested in it, please reach out to us for an assessment. Is it just more an education piece, or is it a bit more in-depth than that in terms of what you need to do to kind of capture your share of that market?
It's twofold, really. One is we have brokers already that are specialising in commercial assets today. So it's just an awareness piece for them to be aware that we have these solutions for them. And then those residential brokers, their own mortgage aggregators are spending a lot of time training them and uplifting them in terms of abilities to diversify their own revenue. So there's a lot of brokers now wishing to move into the commercial space to diversify because prime's become so intense. So it's twofold. One is the awareness factor of those that are already writing these loans. And number two, it's about the education piece, as you say, to work with them to let them expand and help them expand their revenues. But when you think about it, we've been lending to self-employed for some time. So we already understand, the behaviour aspects and the default probability aspects of how SMEs behave. It's just really a natural extension going from a residential security to a commercial security, i.e. factory shop, what have you. So the step is not great necessarily, really when you think about it. And that's why it's a natural progression for us. So, we set ourselves a target last year to write $100 million of commercial assets, or higher margin assets, I should say. And we achieved that. I think we did $114 million for the year, which is, again, second year in a row we've made our targets in that space. So it's not as if we're looking to write, billions and billions of this asset. It's a very considered growth strategy that we have, and I think, one that we can well manage as we move forward.
Okay, perfect. Allan, thank you very much. We're just up on time. Actually, we're just slightly over. Thank you very much for coming back in and joining us once again here on Coffee Microcaps, and hopefully we can catch up with you later in the year.
Absolutely. Look forward to seeing you again, Mark. Thanks, everybody. Have a good day. Bye-bye.
Thank you. And we have Mark, Benson, and the team standing very, very patiently by there. Thank you very much for waiting for us. If you just want to, that Zoom is perfect there, Mark. If you want to share your presentation, I'll let you know when I can see it on deck here.
Right, yeah. Hopefully it's coming up there, Mark.
Yeah, and your audio sounds good as well. So, Mark, you can take it away there when you're ready.
Okay. Thanks, Mark. Thanks for today, and good morning to everyone. My name's Mark Benson. I'm the Managing Director and CEO of Saunders. I've held that position now for about 9 years and been involved in the construction and maintenance industry now for over 30 years. Joining me today, I've got on my left here, Angelo De Angelis, who's our COO. Good morning, all. Got Alex Dunn on my right, who's our CFO. Look, Saunders, bit of a backstory. Saunders is a 73-year-old engineering, construction and industrial assets maintenance services company. We were established in 1951 and we were listed on the ASX in 2007. So basically we're a trusted partner supporting our clients across all aspects of the asset lifecycle, including design, build and maintenance. Our portfolio includes traditional construction contracts and annuity-style earnings, and we span 4 key markets, and they're defence and government, energy, water, and resources and industrial. Our core capabilities extend across 5 key areas, which is bulk fluid storage, structural, mechanical, and piping. We have industrial automation and electrical, civil infrastructure, and industrial asset services. Combined with these 2 acquisitions over recent years in the area of piping and automation, we've strengthened our offering significantly, as well as our ability to tender larger projects. Our share of revenue potential across the addressable market has now increased. We currently have 41 major projects in delivery, and we're supported by a team of over 500 permanent employees. We are a permanent employee company. We sort of don't use much labour hire or anything like that, and have our own P&C recruitment team. And we're strategically located across Australia, New Zealand, and PNG. To support that footprint, we have 8 metropolitan and regional offices, again, across Australia, New Zealand, and PNG, and this really enables us to be very responsive to our key markets and clients. With the largest geographical portion of our forward pipeline, which would be in a few slides, it's located in Western Australia, around circa 26%. We've opened a new office in St George's Terrace in Perth to support these opportunities. Importantly, we've positioned ourselves to effectively service defence bases around Australia, and energy is also a key focus, and our skill sets are directly transferable as Australia continues its energy transition. Look at some of our performance highlights. We've had another record year of revenue of $216 million, and that's up 7.6% on the record prior year. We've had a record adjusted EBITDA of $21.3 million, and that's up 17.7% on a record year again last year. Have adjusted, you'll see that we're using adjusted metrics in this presentation, and that's basically a couple of simple one-off costs relating to acquisition, which has some legal costs, and the automation IT earnout, which due to the accounting treatment, we took it to the bottom line. Our cash on hand is $19.8 million, and that's up 54.7%. And we have no debt in the business other than the standard equipment leases and some vehicle leases. We declared a 2.25 cents final dividend, and that's up 12.5% on last year. And that's basically resulting in a fully franked full-year dividend of 4.25 cents. One of the key things for our business is with the addressable market and our multidisciplinary offer, our pipeline is up to $2 billion, which is 25% up. So this really includes, in FY25, our objective was really to sustain the growth following Saunders' conclusion of Project Camus in FY23. This project was a large US defence fuel storage facility in Darwin that we completed, and we built there about 300 million litres of jet fuel for the US government. And we also set out to strategically evolve our core offerings. So this included leveraging acquisitions in piping and automation to expand our pipeline of opportunities, which has grown to that $2 billion. And these acquisitions support our operating model. And as we've stated, we're already seeing the strength enable us to tender on larger scale, more multidiscipline projects. This resulting in the revenue also includes the acquisition of piping and automation, but it's really also netted off against the divestment of our precast operation in Newcastle, which with the core underlying business from last year producing a similar revenue. This year we've secured a number of major projects which are highlighted on the screen. We've also strengthened our pipeline across 4 key markets: the defence and government, energy, water, and resources and industrial. And we now have a unified, we're unified basically business now where we can do design, building, and maintenance. So, the projects across our key markets and our core capabilities which really is our core capability for the last 73 years, has been around that. We're a specialist in bulk fluid storage and transfer solutions. And basically, combined with our strong balance sheet, this positions us well for continued growth in FY25. Some of the additional highlights, in addition to the acquisition of Piping Solutions in October 23, which has boosted our defence expansion and core structural, mechanical and piping capability, we divested, as I mentioned, our precast operation to Evolution Precast, and as it was really not part of our core strategy, and it really represented marginless revenue for us. Our safety performance has improved significantly, with a total recordable injury frequency rate of 1.35, and that was on the 30th of June, and that's an 83.9% improvement. We find that some of these acquisitions of the private businesses, we have to get hold of their safety and bring them into our systems and work on that, and we've seen that come down again. So we've laid the foundations for future growth. We're continuing on our ESG journey, and that includes our first reconciliation action plan this year. We're improving our supply chain. We're enhancing our customer engagement programs, and we've rolled out a fairly in-depth Together for Safety program, which we're seeing really benefit that injury frequency rate. This year, we've enhanced our board with the appointments of Brendan York, and we've also employed our new CFO, Alex Dunn, who's joined the Saunders team. From our substantial shareholders, it's been reasonably stable, and we declared, as I mentioned earlier, a final dividend of 2.25 cents, which is that increase of 12% for a full year dividend of 4.25, which is fully franked. And based on comparable metrics with market peers, we're good value, and we believe we're currently undervalued. Sorry, let's increase the screen in front of me. We've had another record year in both revenue and earnings. Our core business has remained stable throughout FY24, following the significant step up, as I mentioned earlier, in Project Camus. The revenue growth in FY24 has come from our acquisitions, with a full year of revenue from Automation IT that we acquired in April 23, and 8 months of the revenue from Piping Solutions, which we acquired in October 23. This has been offset by the revenue from our divestment of the precast operation. EBITDA and NPAT have both continued to show strong growth. Our contract mix, if you have a look at this slide, our contract mix is currently about 34% annuity-style contracts and about 66% traditional contracts. Saunders remains well positioned for long-term opportunities in our key markets of that defence and government, energy, water, and resources and industrial. And this represents in our $189 million of order book. And you can see it's been pretty stable after the big step up there from FY22. We're continuing our expansion into the sustainability-related projects as Australia undergoes its energy transition, with 16% of our forward order book representing sustainability-related projects. Our pipeline of opportunities, as I mentioned earlier, has grown to $2 billion as of the 31st of July 24, and this was up from $1.6 billion in July 23. The value of live tenders within the pipeline as of the 31st of July 24 was $1.3 billion, and the remaining pipeline, which is yet to be tendered, which is in the green there, stands at about $0.7 billion. This strong pipeline of opportunities reflects the group's robust and diverse capabilities, and it positions us well across our key markets. We'll continue to leverage our multidiscipline offering in key growth areas, and that's in that defence side, where investment in the modernisation of fuel infrastructure is set to accelerate. Water, where there's significant ongoing investment in asset renewal programs across Australia. And energy, where there's substantial investment in renewable energy assets that provides a platform for our future. With a broad customer base and a strong national footprint, we're well placed to secure larger scale integrated projects And as I mentioned, expect further growth in FY25. Saunders' strategy has really been to evolve from a tank contractor, constructor, to a specialist bulk fluid storage and transfer solutions provider. So this is covering the complete asset life cycle. And this includes projects such as defence fuel installations, water storage and distribution systems, and gas pipelines. This approach moves us up the value chain from a subcontractor to a principal contractor. And combined with our new credentials, including our Federal Safety Commission accreditation and our DISP company security clearance, it really enables us to pursue adjacent government-funded opportunities, such as infrastructure projects like we're currently completing, which is called Bridges for the Bush. You need those qualifications for any federal funded projects above $6 million. Our acquisition strategy has been focused on building and acquiring highly complementary capabilities, and has focused on building and acquiring highly, businesses that fit into our current model. Our combined capabilities have allowed us to expand further into sustainability-related projects. This integrated offering uniquely positions us with clients by it de-risks the project with fewer interfaces, and provides a genuine single point of accountability as a single contractor who self-performs now the entire project. We're highly differentiated in the bulk fluid storage and transfer segment, and we believe we have very limited competition there. Additionally, this expanded offering increases the total value of our projects that Saunders can capture, as well as our addressable market. I'll provide some examples of how this has worked in our strategy in a couple of slides. This has been evidenced over the last couple of years in the growth of both Saunders and our addressable pipeline. Our strategy includes geographical expansion to position us to serve our clients both locally and nationally. And we've developed a deep understanding of our clients' requirements and their key drivers for success, allowing us to closely align our service offering to their needs. An example of this is our investment in skill sets to support the energy transition. Looking at the outlook in our 4 key markets, and overall focus on addressing complementary markets and supporting the energy transition, following the delays in the National Defence Review, investment in the modernisation and expansion of fuel infrastructure is now set to accelerate, with about $3.7 to $4.8 billion of what is really directly accessible for Saunders in that fuel infrastructure spend that's been announced. There's also ongoing investment in water infrastructure across the metro and regional areas, with large capital programs across all states. And this also includes the Sydney Water's $34 billion 10-year asset renewal program. We're seeing continued expansion of bulk fluid storage and transfer infrastructure, along with emerging energy opportunities in new energy, such as biogas and sustainable aviation fuel. The resources and industrial are really central to Saunders' offering. Critical minerals and fluctuating commodity prices now present new opportunities. We just more recently announced a project at Kalgoorlie in the gold, one of the super pits there in the gold mine. Defence is where we've been positioning the business over the last 2 to 3 years. We've been in defence for probably 6 years now. A key component of our growth is this strategy. Defence funding will grow over the next decade with a large addressable market for Saunders. If you look at number 1 on the screen there, the fuel logistics, the fuel theatre logistics, there's probably circa $2 billion of Saunders directly addressable projects in that spend. In number 2, in the Northern Bases spend, Saunders addressable projects are circa $2 billion. And number 3 there, logistics centre spend with Saunders addressable market around that $1 billion. So we're strategically and geographically well positioned to secure key projects in that fuel infrastructure base. There's base upgrades, logistics centres across Australia over the coming years. And you'll see on this slide, the green dots are where we've completed defence projects. And the brown dots there are some of the defence tenders that are currently under evaluation or in the process. You see the big large circles. That's where there's going to be major infrastructure spend by the Australian government in base redevelopments. If you look there at this is really a good picture of our strategy in action. You can see by this slide, this is a complete Saunders project at the Larrakia Defence Precinct, which is up in Coonawarra in Darwin. Saunders has designed, constructed basically where the trucks bring marine diesel in, stored in the tanks, filtration systems, all the electrical controls, SCADA systems, pumps, valves, and the piping that goes down to the wall, down under the wharf and to what's called coke points where ships are actually refueled. And you'll see there our strategy over the last 5 years. For 73 years, we've been doing number one there, the bulk fluid storage, which is about 24% of the overall project. Now we're doing the structural, mechanical and piping, and we're doing the industrial automation. So that sort of secured about a $33 million project for the overall project. So it means we've just got a lot better addressable market and de-risking all those interfaces for our clients, and so they don't have to manage multiple contractors in the same part of working on top of each other. This next one again, Western Sydney Airport, the new international airport. By the time this project's finished, Saunders will have done from, in regards to the fuel systems, again, where the trucks will bring the jet fuel in. There'll be filtration systems, storage, the pumps, the SCADA system, everything that's required to meter the fuel, to send the bills out to everybody, right through to where you plug into the plane wing and fill the planes up. And again, on the left, you'll see there with the bulk fluid storage component, now all these other components we've now added, and that project will be around $70 million of delivered work from the Saunders group. So really, to finish up, we feel we're positioned for further growth. Our outlook, is we have a strong order book of $189 million, as I mentioned. Our pipeline of opportunities sits at $2 billion. Our continued growth reflects our diversified capabilities and strong positioning in key markets. And our focus is on really leveraging that multidisciplined offering in growth areas, such as defence, with that accelerating investment in that fuel infrastructure modernisation. And we feel that we're well placed there and been setting the business up well over the last few years for that starting to roll out. With water, with our ongoing asset renewal programs across Australia, with energy, with the investment in the renewable energy assets. And we've got a broad customer base of blue chip clients and tier one contractors. And we're sort of set ourselves up now for positioning for larger scale projects and continued growth and expansion in FY25. So that's probably happy to take a few questions, Mark.
Thanks, Mark. Yeah, good to hear this story firsthand. Can I just touch on the slides that you just went through there on Sydney Airport and Larrakia? I think they're good slides to touch on. In terms of those two other businesses that have come in there, the structural and the industrial and electrical stuff, in terms of margins within those businesses, are they better margins than the original Saunders businesses of the storage, or are they kind of similar margins? Just touch on what that does for overall margin by getting those two. I know you're getting a bigger share of wallet, but it does improve margins as well overall.
Yeah, look, definitely our strategy has been to continue to move into that. We've always been a specialist business. So those two businesses are very much specialist businesses. The automation side is definitely a higher margin business, being the type of work they do. It's probably 50 plus engineers that are doing work there. So it definitely is a higher margin business. They do anything from they're pretty much a power management controls specialist. So doing lots of work in jails and hospitals, and if the power goes out, the generators turn on and everything gets load shed. They do a lot in that data center management around the world. We've got people sitting in a room monitoring data centers, and that's the same for the acquisition of piping solutions. They're very much a specialist contractor in gas, in high pressure steam, and in hydrocarbons. So with everything we're doing, we're looking to move into that specialist higher margin area.
Okay. And then I just wanted to talk, because I do remember one of your presentations. It's probably going a while back on the bridges upgrades, which was, I think, primarily at that stage in New South Wales. New South Wales seemed to be doing a big push on upgrading a lot of bridges, and I remember you guys were winning quite a number of contracts a while ago. In terms of that, building construction, civils part of the business, is it still primarily a New South Wales focused thing, or because I tend to find, what one council is doing or one state is doing, the others tend to kind of jump on the bandwagon and release their own programs. But maybe just touch on that, because I think a lot of the bridges you were replacing, if I remember from a previous decade, they were like 50 or 60 years old.
Yeah, so that group's going very well. When we did that acquisition in 2017, it was about getting into that bridge space. There's lots of bridges, specifically where we operate. Most of our revenue is all in that group is out of New South Wales. There's lots of bridges out there that are derated or there's issues. So it's been a funding issue for the councils. The government put forward a $500 million Bridges for the Bush program, which it dispersed out to the different councils. So we're still seeing that money flowing out. There's a fair bit of that burnt through. Some of the earlier ones were probably more the simple, less complex bridges, which maybe weren't quite as competitive for us. There's lots of environmental impact statements to be done, lots of that front end, and there was a bit of a backlog there. So we are seeing that they're putting packages together, and we've announced a few there where there's 3 or 4 or 5 bridges put together. And that's really an area that Saunders is very competitive in and brings a lot to the table. So that was part of the strategy of divesting the precast yard. We want the management to concentrate on that part of the business and continue to grow. There is a plan to continue to grow that geographically with opening the office in the West, and we've got an office in Melbourne. So we'll continue to expand, but yeah, predominantly that work comes out of New South Wales, out of that group at the moment. That group also does work through the wider business with some of the civil projects in some of the bigger, the bigger projects that we've taken on.
And then I know you mentioned you tend not to use a lot of contractors. You'd prefer to have your own people in-house. In terms of, demobilization from one project and moving to another project, and delays in government funding or sign off from customers, maybe just talk about how you manage that process of not having people kind of sitting on the bench, if I can use a consulting term, that you can handle that up and down between projects starting and ramping up and ramping down without having people underutilized for large periods of time.
Yeah, look, we are, we're a permanent employer, but when I say that, they're permanently employed for the specific contracts. So we have our core group, which we keep, and that's our core IP, and we've always got work for that large core group. But we employ permanently for the projects that potentially may go from 6 to 18 months, and at the end of that project, they cease permanent employment if we can't transfer them to another job. So definitely on the blue collar side, we don't carry that overhead, and we have to find, we've always got work for the core IP of the business, but our blue collar numbers, fluctuate up and down. We have our own internal recruitment group, and they can do high volume recruiting. So there's a team of roughly 8 in our P&C group. So we're very, very well, it's a fairly slick process of, and our database of people. So our numbers in the blue collar are always up and down, but, the core base over the last 3 or 4 years just continues to grow, and we're always chasing more people. But if there's a bit of a gap between major projects, the team go and have a bit of a spell and come back a week or a month later.
And then I just want to touch on it because you mentioned Sydney Water there, and it's been in the news a lot, the PFAS contamination issue that's getting a lot of airtime. And we had, I don't know if you know Sean Halpin from Skydev on here a couple of weeks ago, who have a technology and a solution to deal with PFAS contamination. But in terms of Saunders and that story that has come to light, does that present opportunities for you in terms of additional, work you can do for Sydney Water, or does it, slightly put a spanner in the works in terms of, projects getting started while they kind of relook at what extra remediation might need to be done?
Yeah, look, it's potentially the latter. In that decontamination side's an area we don't play. But definitely with these projects, in the water treatment type area as well as desal, that's areas that we can play in. So it's like with all these things, when one thing comes through, it tends to trigger another area of growth. But in that area, which we announced just more recently, when it comes to the steel tank construction for the reservoirs, we're definitely a specialist, and we pick where we play in the water area because it can be fairly competitive in some areas. So again, we like to stay in that niche specialist area. So I think we'll just sort of see how that starts to play out over the coming year.
And then I do just want to touch on, because we, don't get too many companies in the microcap space on here that are actually dividend paying. Is there an official dividend policy that the board is working to or working with? And then how does, paying a dividend kind of factor into, acquisitions, whether they be bolt-on or maybe getting into another vertical come into play? Maybe just touch on that first briefly.
Yeah, so we don't have an official dividend policy external facing. There's obviously, if you look at our track record, it's been in the last 4 to 5 years around that, close to 50% payout. This year was 53% payout. So we do understand we're a dividend stock. Our cash position has been, fairly healthy. We've done some acquisitions with that cash. We do have free cash flow. So we feel that we can still pay a dividend, and at the moment still have, what we require as we continue to grow, as well as, continue to do potentially some further acquisitions. Our acquisitions tend to be 50-50 script and cash. If you look back in the last few, with an earn-out period over a year, so that we have everyone involved in the integration, and then we have the previous owners, shareholders in Saunders, and have skin in the game to continue. And we've sort of seen that those acquisitions we've been able to grab and start to grow pretty quickly and integrate through the business. They continue with their existing client-facing work, but we start to add work from a complete project point across Saunders. So, I think history is a good view of what our dividend policy is. And if you have a look back, we've been pretty close to that 50%. And
yeah, perfect. Mark and the rest of the team there, thank you very much. We're just up on time. Actually, we're slightly gone over time. Thank you very much for coming in and joining us. And hopefully we can get you back in later in FY25.
Yeah, no, sounds good. And thank you very much to everyone. And thank you, Mark.
Thanks, everyone. That's it for this morning. We've got just an FYI, another 4 companies presenting tomorrow morning. So please be sure to join us for that. And we'll end today's session. I wish everyone a good rest of their Thursday. Thank you.